All right, everyone. We are live today. This is Workshop 3, Part 4. This is the final part. We've done the historical treatise. Now we're going into the regular versions of everything. We're going to get people on the line, get some people on the line today, right? So we've got the Workshop 3 going on. We also have today, we are going, if you want more information on everything that we're doing, you can set up an appointment with me by texting more at 833-740-2315, or you can contact me directly through social media, social media platforms that we are having. You're welcome to contact me there as well. Okay. And so this is the last of this portion of the series, and we will be moving to workshop 4 tomorrow, which is already scheduled. Everything is been perfect, and everything is working really well for all of us right now. So welcome, welcome, welcome. Those on YouTube, those on Facebook, welcome to the actual program. We had a big day yesterday. Yesterday was a strong day, a big day, but we're going to be talking about becoming your own bank today. Okay. And so what I want to do now is I am going to invite a bunch of people to make sure that they're coming to this event. Okay. So give me 1 second and see if it's going to let me do this. Sometimes it acts right, sometimes it acts up. I'm actually in the wrong account for that. Hold 1 second. Welcome, 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 all that are with us. Glad you are here. And so we're going to go ahead and get started. We want people to climb in, become a part of this. Again, this is part 3. We're going to have part 4 starting tomorrow. Increase your cash flow. Today is the final on becoming your own bank, and we're going to really, really talk about that today. We did the banking historical treatise over the last 3 series. If you missed that, you missed a treat. Last night we had a great show. I was invited on the Lions Den. I'll be back there again. If you missed it, it's on YouTube. You got to check out the Lions Den last night on YouTube. It was excellent. You'll be able to find it in some of the links that we've already had. So what I want to do now is I'm going to go ahead and move forward in this process. And so I'm going to do a quick recap, and then I'm going to go into today's lesson, right? So the first thing that I want to talk about is our um the history. And so we saw the ebbs and flows of the history of banking, right? We saw it go up, we saw it go down, we saw it go up, we saw it go down, we saw it go up, we saw it go down. And so you want to understand these ebbs and flows of banking. Why? Because this is when you're going to know when to invest, when not to invest, and what it is you're supposed to be doing, right? So if we remember in the beginning, banking was unregulated, right? This is when you always want to jump into any industry. It was unregulated. Then what happened is regulation, they created a panic, regulation comes in. Then things changed. The ones that were weak fell off. The strong ones that took advantage of when it was unregulated, they stayed on board. This is where your JP Morgans, your Rockefellers, Carnegies, all of them were vested in this. And this is what had made them strong all the way through this process, right? Now, after that, we see that the corporations were able to bail out the banks, which was a competition to the government. So again, a panic was induced. They came and attacked those companies, and then the government brought in the feds. The feds then what? Regulated and then overtook the banking industry. So we saw that take place. Then we saw the economy crash of 2000, right? And we saw that Alan Greenspan, according to the .com, did not understand the economic or the actual the ramifications actually of increasing the interest rates. Then they tried to drop the interest rates, and then we had the bubble of the banks, we had the bubble of the stocks, and then we had the bubble of the housing all at the same time. 2008, another big crash, right? So we had the 1930s crash, major crash. We had the 2008 major crash, right? And so we saw that in banking. And so we saw that the FDIC came in to also hold people's money up. But the question was asked yesterday, well, which banks do we want to invest in? And I love that, because that is the right wording. Because as we began growing, as we started studying, as we started walking together and learning this information, what happened was we said we're no longer going to do that, we're no longer going to invest in banks. We're going to create our own bank. And so that's what we're going to talk about today and why we're going to create our own bank, right? This is going to be a very important portion of this series, right? Very, very important. So I'm going to get some people in here real quick again, and then we will definitely move right into the subject matter, okay? And so I'm going to send this in Messenger to some people that I know are interested in this, right? Um, I wanted to definitely do that. I want to I didn't mean to do that though, I don't think. Hold 1 second. Let me get this to a couple more people and we're gonna go ahead and get started. Okay. So again, I didn't mean to do that. So hold 1 second. Um that I didn't mean to do. Remove that. Send that. Okay, great. So we're gonna go ahead and get started. So now what I want to do is um move into our PowerPoint for today. Remember, I told you I had some slides that I wanted to create for you all to get you all to the next level. That's why we didn't complete yesterday. I definitely wanted to get some slides ready for you. So let me set up the slideshow and start from the beginning. Let me share my screen with you all, right? And we're going to go ahead and get started for real. So here we go. And you should be able to see it. Right, you should be able to see my slideshow. Please let me know in the chat if you're able to see my slideshow. I greatly appreciate if you could do that for me. Anybody on? So welcome Facebook, welcome Instagram, welcome LinkedIn, welcome YouTube, welcome everybody. If you could put in the chat that you can see, I appreciate it. Thank you so much. Welcome Clara to the call. If you could just type in the chat that you can see my PowerPoint, I would greatly appreciate it. Or no, you cannot see my PowerPoint, but you should be able to see the PowerPoint at this time where it says the average American household. You should be able to see that. Can you? Oh, no, you can't see that. Now you should be able to see it. Correct? Great. I want to make sure. Okay. So we should be able to see it. Okay. So great. So the average American household, 74 cents out of every dollar, right? You can earn dollar you earn goes to banks and the government in the form of taxes and interest, right? Lifestyle, savings, interest, and taxes. You're going to see that, right? So I want you to get this 74 cents out of every dollar you earn goes to banks, right? And the government in the form of taxes, and interest. Okay. You said you can't see it, Claire. You should be able to see this. I'm going to go check on my page just to make sure that it can be seen. Give me 1 second, guys. I want to make sure you guys are able to take advantage of this. Yeah, I can see it. So I can see it clearly. So it's on there. So it's being recorded. So you'll be able to see it on the record if you're not able to see it now. That has something to do with your computer. So 74 cents out of every dollar you earn goes to banks and the government in the form of taxes and interest. So lifestyle, right? 23% is going to taxes. That means because everything you're buying, you're paying taxes on it, right? And we did our workshop on taxes, right? Workshop 2 was based on taxes. So our lifestyle, 23% is going to taxes. Savings, 3%, right? Interest, 34% of your money is going towards interest. And then taxes, 40%. So lifestyle, 23%. You're still paying taxes on this, as I was saying. 3% is the average person's saving amount. Interest, 34%, right? And taxes, 40% is coming out of your pocket. So 40% is going to taxes and 34% interest. So that's going to equal that 74% that it's talking about over here. This is extremely powerful. Why? Because we want to reduce taxes to zero, right? Which we talked about in our workshop on taxes. And we want to reduce our interest that we're paying out to zero, right? We want to, that's our goal. to get those to zero. Right now we can spend more on our lifestyle, or we want to put all that into savings, and I'll show you why we want to put it into savings on this today on this program. Okay, so I want you to be clear. I'm going to share with you why we want to do this. This is very important, right? So we want to increase savings, reduce interest, and reduce taxes to zero. This is our goal that we're paying out. And we want to flip this into interest that's coming into us versus interest that we're paying out, which is extremely important to understand that concept. So instead of paying out interest, we're going to have interest coming back to us. And this is what the wealthy do. And they get their taxes down to 0 to 5%. The majority, zero. So this is what we want to do, right? If we do that, what would you do if you were making $100,000 a year and now you have an extra 23 to, or yeah, I believe 28 to $32,000 coming in every single month? What would you do with that extra money? We're going to turn that into more money through savings. And I'm going to show you how to work that. Okay. This is the key to the game. All right. So now, what most people try to do to get out of debt, this is what, what's the guy's name? I can't think of his name. And it's right on the tip of my tongue. But he's the guy that talks to everybody. You know who he is, but it'll come to me. But he talks everyone into getting out of debt by lowering their lifestyle, right? That's his goal, is to lower your lifestyle to the point where you're almost homeless. And then you start buying your way out of debt, right? That's not how we're going to get out of debt. We're not going to follow that program. We're going to follow the wealthy people's program. That program is a program for poor and middle class people. It is designed for that, right? And it works. Don't get me wrong. I'm not mad at people that get out of debt using it, because it does work, and it's a good thing to get out of debt like that. The Ramsey Show. That's what I'm thinking about. Dave Ramsey. We're not going to follow. That's not the program we're going to follow, right? We're not going to ask you to minimize your lifestyle to become wealthy and get out of debt, right? What we're going to do is we're going to find money that is going to actually help you get out of debt. So I'm going to show you that in a minute. So the traditional approach to get out of debt is by working harder, spending less, saving more, refinancing, consolidating, and debt snowball, right? So I want you to get this: working harder, right? So this right here means adding more hours to your job. We don't want you to do that. You are welcome to do it if you want to, but that's taking more time out of your life. We don't want to do that. Spending less changes your lifestyle. Now, we do want you to spend less in the mindset of, I don't want you to spend anymore. I want you to invest. Spending less in this sense that they're talking about is not investing more. Spending less means you're now going to use that money to go pay off debt, right? To a degree. And it's a different idea. So we're going to talk about this in a minute. Saving more, right? Which is good. We want to do that. You're going to save more, but we're going to show you how to do it properly. Refinancing, right? Which you're welcome to do that, but we don't advise you to refinance, especially at this time. It's not time for refinancing right now. Consolidating, right? As well. And so this is about shrinkage. We don't want shrinkage. We want you to maintain where you are. However, we want you to now be able to come out of debt, right? In a more contemporary way. And really, it's not a contemporary way. We want you to do it in the way that the wealthy been doing it for hundreds of years. Okay. So remember, there's two universes when it comes to money. There's a universe for the wealthy, and there's a universe for the poor and the middle class. This universe is for the poor and the middle class. Remember, if the masses are doing it, question it. If the masses are doing it, question it. The masses are doing this. This is traditional. Traditional means average or what the masses are doing. That's the traditional approach. This is not the traditional approach that we're going to talk about next. This is reallocating inefficient dollars. You will always hear me on these programs talk about how we're going to find money that you're already making. That's called reallocation. This is the strategy that the wealthy use. This is reallocating funds that you've already got coming in that you're not aware you could be using towards, right, your freedom, towards becoming wealthy, towards debt reduction. Okay. This is important. All right. So let me go back to the PowerPoint. I do apologize. You all see in the PowerPoint, but I can't. There we go. And so let's say credit card. Here's your balance, minimum payment, actual payment, extra money, $150. Right? We're going to find that. Medical dental, 2,420. Let's say that's real. Minimum payment, $80. $180 is the actual payment that you're making. Extra money, $100. Furniture, right? And we're looking at the minimum payment, actual payment, $50. We're just using this as an example. We're finding money that we can actually save you, right? That's going to take you to the next level. Okay. Now, your total debt, your minimum payment, your actual payment, you're looking at 625 extra dollars per month, right? In the average household, right? Or in this example, rather, right? That's available for you to be able to reallocate. And now we're going to reallocate those funds to be able to take you to the next level, to be able to save or to be able to uh, now take that money, put it aside every month. It's now going to get you the highest amount of what? Interest. And you're going to be able to actually double dip and reborrow that money. Okay. So you're going to be able to double dip and borrow again from yourself the money once you open your own bank with us. Okay. This was where this right here is where you're going to win. See, banks, you don't understand. Banks can dip 9 times or leverage. You saw it called leverage when we were dealing with the historical point when they was talking about 12-to-1 leverage, but then they made unlimited leverage. Well, the banks have a 9-to-1 leverage. They can take, if I put $1 in the bank, they can invest that dollar 9 times in 9 different areas and 9 different things that they want to invest it in, right? Over 9 times. They can multiply that dollar by 9. So every dollar that comes into the bank, they can legally multiply it times 9. Well, when you become your own bank, you can actually leverage your money twice. They won't let us do it 9 times like the banks, but they will allow you to. Now the regulations say that we can double dip. We can use that money 2 times. So that $625 a month can now become what? $1,250 per month. This is the power of what I'm sharing with you. This is what the wealthy do. Now you can start to begin to understand why they're wealthy, because every dollar they make, they can actually use it twice instead of once. Right? This is very important to get that concept, right? So now, right, what we want to do is we're going to move into another zone of this, and I'm going to go into, I want you all to see I want you all to see the cash flow statement again. So let me share a different screen. Okay, I need to share a different screen real quick. So we're going to come back to our form that we've been using. And this is the income, expense, cash on hand accounts. And I'm using a blank one, right? Remember, we had the field one that we filled out. So if you missed that, if you missed our other, our understanding money workshop, you need to go back to that possibly to really understand this cash flow statement. Or actually, this is actually this is a balance sheet here. Or excuse me, this is a balance sheet. This is an income statement. So the income expense column is an income statement. The assets and liabilities column is a balance sheet, right? Then we have investments, interest, accounts, and cash on hand. And I would add that investments to the balance sheet to a degree as well, but not to a degree because the investments are assets as well in their world. But in the wealthy world, when you understand it, assets are not. And we already discussed that, so I'm not going to go back into that. So, income, right, which is very important here, income coming in, right? The average person has what? The poor and the middle class have a job, correct? They have a job. They're going to also have expenses here, right? So let's say like gas and electric. So I'm gonna call that electric, water, phone, cable, right? Coming into their house. This is what the poor person is gonna have. They're only gonna have a job as income or welfare as income. They can have welfare as income, right? Public assistance. So they can have job and welfare, and they're gonna have electric, water, phone, cable, the average bills. They're not gonna have assets or liabilities. They're not gonna have investments. They're not gonna have accounts usually, but they will have cash on hand as well. They will have cash on hand a lot of times. Okay. So the majority aren't gonna have that. And they're definitely not gonna have interest coming in. The middle class are gonna have a job, right? Electric, water, phone, and cable, usually, and they're going to have liabilities. What's going to be their liability? Their home, car loan, credit cards. These are all liabilities. Okay. This is what the poor are going to, I mean, the middle class are going to have, right? They're not going to have assets. They're not going to have investments usually. They might have a 401k, but that will go into, let's put that in accounts. 401k, because that is an account, really, right? And they're going to have they might have an IRA or a Roth IRA, right? But these are going to pay out right now. They're paying out about 1%. They're going to be tax deferred. The majority of them are going to be tax deferred, right? And let's say this is paying 3. Let's say it is paying 3%. Oh, I got it already set up for percentage. That's why. Okay, and it's paying 3%. So let's say that this is what the middle class is pretty much going to have, and their job is going to be giving them these things. Okay. But what's the issue? They're going to be fee based. They're going to be penalty based if you pull the money out early. And they're going to be tax deferred minus the Roth IRA is only you only pay taxes or a penalty on it and a penalty on it when you do it before you retire. A Roth IRA, if you pull the money out after you retire, it's good. So as a retirement account, a Roth IRA can be good if your company is doubling and they're matching what you put in it. So if I put $100 in my Roth IRA, they're matching another $100. So I'm actually putting 200 in my Roth IRA. If that's the case, then that is a excellent investment product to use because you can take this money and put it in our no yield interest accounts. That could be a good thing. But the 401ks and the IRAs, right? Because they're going to kill you on taxes whether you're retired or not, and they have rules and regulations guiding them that hurt the people. And these are supposed to be retirement funds, and I'm going to explain to you why we don't want to do that in a minute. Now, what the wealthy are going to have, right? they're not going to have a job. They're going to have what's called assets, bringing them in money, meaning they're going to have rental properties. I'm sorry, not the wealthy, the rich, not the wealthy. The rich are going to have these. The rental properties, right? They're going to have electric. Excuse me, not electric. I'm sorry. They're going to have like rental properties. They might have stocks that are paying dividends, right? And so forth. So all of this is bringing them in cash flow, rental payments, right? Dividends are bringing them in cash flow. And they'll have other things as well. They could be invested in a lot of other things as well. But I'm just letting you know, they're going to have assets, right? Their home could even become an asset in the long run, but we're just going to say that they got a mortgage here, right? That they're not making money on, but they usually are going to make money off their house somehow, right? Car loan, they might have, might not. Credit cards, they might have. They're going to have investments. They're going to have stocks that they're flipping, right? They're going to have investment properties, right? These are only going to put cash on hand once they're sold. This is what you're going to find a rich person having. A rich person. This is above average. The average person is going to be poor or middle class. The above average are going to have assets, but the true wealthy are going to have high yield, no risk accounts. They're going to become their own bank. They're going to have high yield, no risk accounts, non-taxable. These accounts cannot be taxed going in or out ever. And they're going to yield anywhere from 5% to 30%. 5 to 30%. Right? So I'm just going to use 30% here because it's not going to allow me to do the other. Why did you switch? I need you to do percent, but that's okay. 30%, right? They might now the difference between the rich and the wealthy is that the rich might have 401ks, IRAs, and Roth IRAs, but the wealthy are not going to have those. They're going to have their money in these high yield, no risk accounts, non-taxable. If they have these, it's because they're playing some type of game. They're doing something. But this right here, they're going to have these. Right? You might also see the middle class have mutual funds and the what's called, but the wealthy are going to have these high yield, no risk accounts. It's going to make a big difference. Why? Because they're going to have interest coming in, and they're going to be living off of this interest. They're going to have these accounts here, and they're going to be living off this interest. And this is the key to the entire game, right? So, what I want us to get is that the key to that interest, right? And I do apologize if you couldn't see that. I do apologize on that portion, man, because I might have had that shut down. I'm hoping you could see it, but you at least got to hear it. But they're going to have these accounts, right? So the income, right? I'm going to do a brief overview on it just real quick again for you, just so you can see it. It's important. Is that I want to go back here. These high yield accounts. I mean, the wealth, the poor is going to have a job here in the income statement. They're going to have an expense here in the electric, water, phone. They're going to have those expenses. They're not going to have assets. They're not going to have liabilities. The middle class is going to have a job here in the income. The expense, they're going to have electric, water, phone, and cable. The assets, they're going to have they're not going to have any assets. They're going to have liabilities, home, car loan, credit cards. The wealthy, I mean the rich, are going to have investments, stocks and investment properties, as well as assets, rental properties and stock dividends that is going stocks with dividends that are going to pay them out rental payments and dividends, and this will be their income. They're going to have, they possibly might have 401ks, IRAs, and Roth IRAs as well, right? But they're not going to have the high yield. The wealthy are going to have the high yield, no risk accounts, non-taxable. This is what they're going to have. And I'm going to show you the difference, and you're going to understand extremely quickly why the wealthy are wealthy and the poor are poor. So hold 1 second. I'm about to switch this back to the PowerPoint. I do apologize for that disruption. Hold 1 second. I do apologize for that. I wish you guys would have got to see that while I was walking through it. Here we go. And so now we're here. We dealt with reallocating efficient dollars. So what I want to deal with now is what's called the average rate of return versus the true rate of return. And this is very important to get, right? Because you need to understand the banking, the stock market, when they're talking about your rates of return, you want to make sure that they're talking about the true rate of return and not the average rate of return. And here's why. Let me make sure you all can see this screen, right? I do not want to go through that again. Nope, and you can't. So see, there I go. Here we go. Now I got it. And excuse me, like I said, this is a new system, so I'm getting used to this system. My other system would automatically show up. I wouldn't have any issues. But with this, I got to make sure that I'm learning the system. Okay, here we go. So I'll answer that question a little bit later. I'll answer that question in a minute, Claire. So history of stock market and economy. So what I want you to look at here is, this is an example. If I invest $100,000, if you invest $100,000 and you have a 50% increase, right? That means that you've earned you've earned $50,000. So now you have $150,000, correct? On the average rate of return, right? So that's going to be 50%. Now, in year 2, if it comes back down to 50%, if it comes back down 50%, how much would you have? How much would you have if it came down to 50%? You could type that in the chat if you want to, right? Because I want to see some answers. How much would you have if it came back down 50%? All right, what you would have, right? You would actually have, I apologize, I'm on the wrong screen. There we go. You would actually have $75,000 because 150 divided by 2, which would be 50%, is 75,000. So they're going to tell you the average rate of return was 0%. It went up 50, it came down 50. They're going to say that's 0%, but it's not. It's actually negative 25%. You ended up with less than what you started with. So a lot of times when they're telling you what the average is or what's the average return, they're telling you according to the average rate of return, not the true rate of return. And you want to make sure you're getting the true rate of return, because if I see the average rate of return is 0, right, and I'm putting my money in here, I think this 100,000 is going to stay, but it's not. It's going to drop down 25%. That's a large loss, 25%. Right? That's a lot of money to lose. So the history of the stock market and economy, right? The stock market's average rate of return is 7.5%. That's the average. But the true rate of return, 1901 to 2011, and this talking about 1901 to 2011 as well, is 5.06%. But in reality, after you take the money out, because you got to pay fees to take out your money out of the stock exchange, and then you have to pay taxes, right, for your gains, right? Capital gains tax, basically, is what you're paying when you pull stock out. So that's so you end up with about a 3% average return over this time. It could be more, it could be less, depending on how long you had it in the market and all that. But this is an example of a true rate of return. Well, what if we could get those taxes and fees down to zero? See, this is the key. This is our goal. This is the goal, right? So what if I could show you how to double your cash flow, eliminate debt, and self-finance growth like bankers? What if you accomplish this without working harder, sacrificing your lifestyle, or spending any additional money? And so as I put on the screen, I said, for more information, text savings to 833-740-2315, right? Exactly. So I'm gonna hit this right here for self-identification. Or station identification, excuse me, for station identification, and then we'll be right back. All right, so again, we're on workshop 3, become your own bank, part 4. If you missed part 1, 2, and 3, it's important that you watch that. We also had our workshop 1, understanding money. If you missed that, make sure you watch that. And workshop 2, legally avoid taxes. Very important that you watch those. And then tomorrow evening, we will have increase your cash flow as well. Tonight, we will have the again, we will have a presentation with all of the information, everything that we offer, everything that's going on. For more information on that, you can text me or anything like that. The number is on the screen. If hopefully you can see it, but it's saying text savings, SAVINGS, to 833-740-2315. Again, that's 833-740-2315. Okay. So here's the key thing that I want everyone to get is that if I could show you how to double your cash flow, eliminate debt, and self-finance growth like bankers, right? Is that something that you would want? What if you accomplish this without working harder, sacrificing your lifestyle, right? Or making any additional money? And we've already talked about that when we dealt with reallocating the funds, right? But I want to show you something else. Now, this is how the market moves: up and down, up and down, up and down. Now, here's the thing that we want to get: your 401k, Roth IRA, and IRA are attached to this at this present time, where they're going to always be if you stay in those instruments, right? So, or vehicles. So what happens is, as the economy goes up, right, your retirement looks good. But when it comes down, your retirement looks bad. And according to all the analysis right now, right, the financial analysts, according to all of them, basically the economy is about to crash. So do you want your retirement attached to that? No, you don't. And so what we offer is uninterrupted compound growth. And this is what I'm talking about when I say high yield, no, right, high yield, no interest, non-taxable accounts. And what happens is these accounts now grow exponentially. So what happens is, as the market goes up, you then gain. When the market drops, your money stays here and flatlines here, and you keep getting paid at this interest rate. When it begins to go up again, you get paid more. If it decides to go down, you stay at the peak and flatline and go across until it goes up again. So now your retirement is based inside of the increased growth. Now, that's if you use it for retirement. You can use these accounts for anything. But the key thing that I want you to get is that you can borrow against it, right? You can borrow against it. So I want you to understand that you can actually borrow against the compound wealth. I mean, against this compound growth. You can borrow against your account. And when you borrow against it, it allows you to use your money again. Or you can put that money into another account and let that compound growth. And then you pay yourself back, right? And you end up with a profit. Or you can use it to pay your bills. And they're going to continue to do what? What are these going to do? These are continue to drop. They're going to continue to yield money off the interest. So they're going to keep dropping more interest payments into your interest account. And as you begin to get these interest payments, they're going to grow, grow, grow. You can now live off of the interest payments versus income. And now what are you going to do with your income? You're going to drop them in the high yield risk account, no risk accounts rather. And now that's going to grow and grow and grow. High yield risk accounts 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 grow. And that high yield no risk accounts, excuse me, high yield no risk accounts grow. High yield no risk accounts grow. And now you're putting your money here. And so it gets bigger and bigger and bigger, but you're living off of this money over here. So let's look at that in real time. Let's say we put over here, let's say you start putting in, let's say we got $5,000 in this account. Let's just use some real life. And we're saying we're at, and let's say let's start at a reasonable rate. Let's start at 15% on it, right? High yield account, we got 5,000 here, right? At 15%. That's yielding $750 a year coming in right now off of this. But let's say I continue to put more money here. Let's say I put in another 5,000 this month. Because I've already got assets, right? Investments and so forth. I'm just using that example. Right? I put another 5,000 in and I got 10,000, right? And I'm at 10,000 here. And now we're at 15,000, right? And I'm sharing the wrong screen with you all, I know. So hold 1 second. I got you. Hold on. I got to get used to this system. All right, give me 1 second. All right, so you should be with me now. Let me make sure. Nope, you're not. You are now. Let me get back to the screen. You are now, right? Yes. Okay, you guys are with me now. So again, the number is, write it down. It's 8. I'm gonna put it in here, okay? And then that way you should be able to get it. 833-740-2315. Okay. So that way you have it now. All right. And then I'm going to send it to you again. I will inbox you the number as well. But I want you to make sure that you get it. I don't want you to lose that. Now, the next thing is, so again, we got 10,000 here in a high yield risk, no risk account, excuse me, high yield, no risk account, no non-taxable, 15%, right? And that's going to bring in $1,500 that year. And we just keep adding to it. Why? Because we got payments coming in, and now we're going to we want this to get as big as possible until it can pay our bills. Once this can pay our bills, we're celebrating zero, meaning all my bills are paid. That means every dollar that's coming into my household now is free and clear. I got free and clear money coming into my house. Right now, all this money we keep putting into these accounts, and this will keep growing and growing and growing and growing. So when we get this up to, if we did $5,000 a month, by the end of the year we're at 60,000 a year in here. We're at $9,000 per year coming in. Right? We do that again, we at 120,000. Now we got $18,000 a year coming in. We do that the third year, right? And this is compounding. If we don't take any of this money out, it's actually adding to this, but I'm not doing the compounding part. So now we're going to do, let's say we do 100 and what's that? Another 60,000 would be 180,000, right? I'm sorry. I did 18,000, 180,000. I keep doing. No, that's 180,000. That's $27,000 a year coming in, right? And it keeps growing and growing and growing. These are high yield. Remember, these can go up to 30%. But however it goes, the point is you can put as much money in as you want, or the least, or the minimum is $300 into it, right, per month, and then you can start growing from there, right? But the first thing you want to do is that I want to start all the way over real quick, and then we will close out because I want us to get and understand this concept. I'm gonna clear all of this. And this is something that we ask people all the time is, are you happy with your retirement account as it stands? If you don't have one, you can definitely say no, you're not. If you have one and it's only giving you a 1% or 2 or 3% return, absolutely not. You're not happy with that account. And if it's going to go up, if it's going to ebb and flow with the market, you definitely can't because it's not stable. It's not sure. If the economy crashes and it's time for you to retire, you're actually broke. You don't have any money in your retirement. So they are those are dangerous accounts, right? The stock market can be extremely volatile. Those are very, I mean, if you don't like risk, right, which the average person is afraid of risk, a 401k and an IRA, that is extremely risky to play games with your retirement, right? So that's why we say this is the way to go, right? So the job, I didn't mean to do that. So the job, you got that, right? Is what you have coming in. This is cash flow, right? You have expenses. This is the poor person has expenses. They don't have any liabilities, so they don't have any debt. Expenses are not debt. Debt is something that you can pay off that you're paying a monthly bill on. So presently, you might not have any expenses. Okay. So this is key to understand the difference between an expense and a liability, right? An expense is not debt. These are things you can never pay off: electric, gas, stuff like that, right? So you have job, you have expenses, and then we will go in and find that extra money, and we will start you on a process if you have debts to pay off debts. If you don't, to get you into an account, right? The high yield account. And that's our goal to start you, get you in that high yield account. This is then going to do what? Pay you interest starting at 5%. We can start there, right? And now you're going to start living like the wealthy. This is your first step into becoming wealthy. But now remember, you can borrow this money and put it in another high yield account. So let's say I got a high yield account that's hitting me with that I'm getting 5%. I can double that money again and now get what? 9% on this one, possibly. Now I got another high yield account, right? That's giving me 9%. And then I can borrow from this high yield account and do another one. And this is lower. So I actually walk away with 4% profit on this if I pay this back whenever I pay it back, because you make the terms on when you're going to pay yourself back and how much you're going to pay yourself back and what the percentage is going to be. And this is key. And so this is how you end up with a profit. Or I can borrow from this and pay an expense or a liability off. I can start paying these bills off with these accounts. And I can do this unlimited times over and over and over again. I can make as many accounts as I want. So what we advise is you get with me We do our initial consultation. Then after that, we get you to the experts that are going to actually put together a plan and walk you through the process of becoming wealthy. And I want you to understand, every program or product that we offer or service that we offer is no risk. In other words, if you follow the plan, you will become wealthy. There is no risk for you not to become wealthy. It would be, in other words, it would be impossible for you to become unwealthy. So now I'm going to move to questions. I know we have some questions in the chat, so I'm going to go ahead and move to questions. So before I go into questions, let me do station identification, and then we will go there. All right, everyone. So again, we've got workshop 3, Become Your Own Bank. We're on workshop 3. We've already done 4 parts to this. We're going to be on workshop 4 tomorrow. Okay, we've already done workshop 1, which is understanding money. Workshop 2, legally avoid taxes. We are finalizing tonight. This will be today. This is the last one of Become Your Own Bank. This is a 4-part series. It was hopefully you all got a lot out of it and enjoyed it. And then we have the workshop 4, increase your cash flow. So now I'm going to move to the question and answer. All right. And so hold 1 second for me. Let me get there. And I'm going to go to questions. So I'm going to go back into the chat. Let me see if there's any questions. Here we go. Question number 1. What can a person do? What can a person do? What a person want to invest some of their social security check? Yes, you can invest a portion of your social security check. You can do that. Yes, you can. All right. What is the number again? The number is 833. Let me put it back up on the screen so you have it. The number, you're going to text savings. You're going to go into your text and you're going to send SAVINGS savings to 833-740-2315. That is how me or one of my reps, we will call you and contact you to set up the consultation, the initial consultation. Once we set up the initial consultation, we will then move forward from there. Okay. Now, the next thing is, or we'll get you more information. If you just want more information, we'll get you more information also. But the initial consultation as well, you can set up right then if you would like. And then the next question is, let me see. In what bank can I invest my money in that will bring me profit? No bank. You're going to create your own bank. Right? You're going to create your own bank. You're right. By the time you become 62 or 65, right, they might not have a social security. That is true. They might not have social security. Therefore, you need to start investing now. And that is the key. And so we've been able to help people reduce debt from 30 or more, like 30 years down to 5 and 7 years. That's how powerful this high yield, no risk, non-taxable accounts, your banking account will be. You become your own banking. And because of that, the things that it affords you to do allow you to be able to come out of debt much quicker, because you're going to be having interest payments that are going to allow you to multiply your money extremely or way faster than the average person. See, there were banking instruments that were given to the poor and the middle class. For instance, when we were talking about taxes, you file a 1040, but what the wealthy file is what's called a 1041, right? I'm going to give you a call specifically, Clara. I'm going to give you a call specifically. I know you're very interested. So right now, I need you to text me or contact or text me your phone number so that we can talk. Not here, text it on Facebook and Messenger. All right. And so that way we can get you started. So there are tax implications, right? Where, or no, they're forms. So but the wealthy fill out a 1041, but you can't even get hold of a 1041 without asking for it. So they're only going to put out the regular forms for you, the forms that the average person uses. When it comes to investment instruments, they're going to offer you the investment instruments like a 401k, a Roth IRA, a mutual fund. Those are instruments designed for poor and middle class individuals. They're designed, right, to make sure you what? Never become wealthy. That's what they're made for. Once you understand that, when you can lock that in, when you can get everything designed for the average person, the things that I know about, like when I say I'm talking about the average person. The thing that everybody knows about is designed to keep you poor and middle class. The things that you don't know about, the things that sound absolutely crazy to you, the things there's no way that could be real. That's what the wealthy are using. That's why they're wealthy, because they have uninterrupted, as we talked about, they have uninterrupted compound growth. While the average person has growth and then down, and then flatline, growth up, then down, then flatline. Theirs goes up, flatline, up, flatline, up, flatline. But you can't believe that because you've never heard of anything like that, because you weren't supposed to, because you're not in that circle. So if the average, this is something that you need to write down, and you need to put it on your wall or something in front of you so you never forget it. If the average person is doing it, right, there's something wrong with it. If the average person is doing it, right, you need to really investigate it. It don't mean it could be right, but you need to investigate it totally. Be very, very, very skeptical of anything that the average person is doing. So if the majority of people have a IRA, you need to be extremely skeptical of that. If the majority of people, if it's being promoted, you need to get a 401k. You need to be extremely skeptical of that. Right? So I want you to understand and be really clear. So with that, guys, I appreciate everybody's time. And again, we will be on tomorrow night at we'll be on tonight at 7:30, right? And we'll be sharing with you all the information, everything that we do, what's going on. So if you want that information, just either like, comment, or inbox me, and I'll get you the information for tonight's show. Just put tonight, type in tonight or something like that, and then I'll get that to you. The other thing is tomorrow night we're going to be continuing with the workshop for increase your cash flow. It'll start at 8:30 p.m., 9:30 p.m. Central Standard Time, Eastern Standard Time. So 8:30 p.m. Central Standard Time, 9:30 p.m. Eastern Standard Time, right? And so we're going to be looking at increasing your cash flow and what that means, right? Which is one of our programs in here. This will be a one-part workshop, more than likely, because I don't have to do any historical treatise. We're going straight into how we're going to increase your cash flow, and we'll be coming back and really looking at what we were talking about with reallocation and how we're going to get you an instant pay raise without you working a job or without you actually having to start a business. But you can, because there's many ways to increase your cash flow, but there's other ways that we can do it as well. And so we're going to deal with the person that's that's an employee, or the person that's a S, which is self-employed, or a person that's a B, has a business system, or a person that's an investor, or a person that's wealthy already, right? Or the self-made millionaire. And so we're going to deal with it on every level. We will deal with that tomorrow starting at 8:30 p.m. Central Standard Time, 9:30 p.m. Eastern. I appreciate everybody's time. Looking forward to talking with you all soon. See you all at the top. I love you with the perfect love, and there's nothing you can do about it. So with that, have a great evening. Peace.